Hey everyone, it's Kevin from KL Investment Strategies, and what I'd like to do today is a little lesson on what they call stochastics. In investing or trading, it's a way to gauge buying and selling momentum. And the stochastics, these are stochastics here that you can add to your charts. So what I'd like to do is talk a little bit about how traders or investors use those to determine when to either buy or sell investments. So what we're going to start with today is the SPY, which is an ETF that kind of mirrors the S&P 500. So in your stochastics, you can see we have 100% in this area here, and then down here we have a 0. So what we do with stochastics is as selling occurs, your stochastics go down. When it gets down below 20 or in the 0 range, that indicates that a stock is oversold, and typically you're going to see a reversal back to the upside, and then vice versa. When you see that the stochastics get above 80 or 100, then you are going to typically see a reversal to the downside. So in the S&P, what we saw here is the stochastics got oversold, and you can see the stock broke back up in the opposite direction to the upside. These are your period moving averages, with your 20 being the green, your 50 being the blue, and this is the daily chart. So what happened was is as the S&P came up, you can see that it broke these period moving averages and continued to go all the way up to the red line, which is your 200 period moving average. Now when you see your stochastics stay above 80 for a period of time, that's what they call embedded stochastics, and that's a very bullish sign. That means the stock market is continuing to go up. Now in this particular case, once we hit the 200 period moving average, you can see the stochastics started to go down, and once you see the red line drop below the blue line, that's what they call a stochastics rollover, which means typically that the stock is then going to reverse to either the upside or downside. And you can see here we got a stochastics rollover to the upside, and here we're getting a stochastics rollover to the downside. So what I'd like to do is I'd like to show you a couple of stocks that I got into last week and show you how I got in, and then also when I took my profits. So we're going to start out with Corning, stock symbol GLW, and you can see here we had our stochastics roll over here. So you could have either gotten in this price or when it broke the 20 period moving average. Now for those of you that are familiar with patterns, this is actually an inverted head and shoulders, where you have a shoulder here where it held the 20, and then your head is here. And what you do is you measure from your shoulder down to your head, and then you can typically expect this to measure from this distance and then go up this about the same amount. But as you can see, we did get embedded stochastics. We got a stochastics roll over here. So I got in right here in the 13 level. When we became overbought here, I took profits in this area, and then I took profits in this area. The next stock that I want to look at is Ford. Now this stock here, I actually got into in this area here as we were pulling back. I want to see if this area is going to hold, because you can see our stochastics are coming down, and if this 20 period moving average holds and our stochastics comes down, then this is the area that I want to start getting back into this stock. Now in pre-market on Ford, we're actually at 1135, so we're actually down into this area. So I'm going to hold off and see if our stochastics come down below the 20, and then I'm going to look for the 50 period moving average to hold. The next stock that I want to look at is, let's see, how about Sprint? That's one that I got into when we got into our stochastics rollover into this area, and then you can see that we got above the 20, but then we couldn't break that. So I'd like to show you the 15-minute chart, because this, what I've been looking here is the daily. And if you look at the 15-minute chart on Sprint, right in this area is what we call a 20, 50, 200 squeeze. And what happens is we break the 20, we break the 50 on an oversold stochastics area here. And as you can see, we got up to that 280 level. We got into an overbought stochastics here. So I took profit in this area, and then I took profit in this area to get out of those positions. So you can see on our stochastics, each time we get into an oversold level, typically a stock will go up, and then when we get into an overbought level, then the stocks typically go down. So that's one tool that traders use, especially for a technical way to determine when to get in and when to get out of stocks and when to take profits. So that's how you use stochastics. Look through some of your stocks, put in your stochastics into your charts, and just pick a few stocks and watch and see how they do every time they become overbought and oversold. So that's your lesson on stochastics today, and we'll talk to you soon.